Hello everyone, welcome to this video on AS A-Level Accounting Past Paper Analysis. In this video, we are going to analyze the papers of May-June 2022, and in that we are going to analyze paper number 31, 32 and 33. So before beginning the video, let me tell you, you were supposed to first practice the questions on your own independently, then come to this video and then see whether your answer is correct or no, and then see how do I analyze the question, read the question. That will make you improve in your upcoming exams. If you want to learn AS or A-Level accounting, you can either consider watching the videos in the playlist. There's a dedicated playlist for financial accounting and the management accounting, or you can consider purchasing the online course for AS accounting and for A-Level accounting. So let's begin this video. First, we will begin with paper number 31. Question number 1. MC Sports Club provides sports facilities, operates a cafe for its members and hires out its meeting room. The treasurer of the club provided some of the financial details for the year ended 31st December 21. These are balances at 1st Jan 2021. So these are all opening balances, equipment, inventory of cafe, amount payable to cafe suppliers. So these are trade payables. Deposit paid to a hotel for annual dinner. Basically, this is like a prepaid expense. So we'll call it prepaid expense. Receipt for hire of club's meeting room. So income received in advance. So I'll call it advance income. All these are at the opening date. Annual subscription of each member is $200. New members are admitted in the first half of the year, have to pay the annual subscription in full, that is $200. But new members are admitted in the second half are supposed to pay only 50%, which is $100. Details of the number of members for the year ended 31st December 2021 were as follows. So at the opening, there were 420 members. Then in the first half, 18 members joined. Second half, 24 members joined. And the number of members whose subscriptions were in advance or in arrears are given opening and closing. Important thing, all these subscriptions are to be calculated as full subscriptions. So $200 per member will be applied. Okay, all cafe sales for cash at a markup of 80%. So whatever is the cost, on that they add 80% to get the selling price. Or in other words, gross profit is 80% of cost. Payment to suppliers 42,000. Amount owed to suppliers, which is closing trade payables 13,600. Inventory of cafe at the end was 10,200. So closing inventory. Other receipts and payments are given. Purchases of equipment, this is the payment. Club expenses payment, cafe wages payment, final payment to hotel for annual dinner payment, receipts for hire of meeting room, receipt. Club equipment to be depreciated 15% using reducing balance. Okay. Next page. Answer the following questions. Questions are, okay, fine. Part A. State 3 differences between the financial statements of a not-for-profit organization and those of a limited company. So if you remember, or if you know the financial statements of a limited company, so what are the contents of financial statements of a limited company? You will prepare an income statement, you will prepare a statement of changes to equity, and you will prepare a balance sheet. But in, okay, let me call it profit organizations. Okay, not profit organization, we'll call it limited company. Whereas for a not-for-profit organization, what are the contents of the financial statement? Income and expenditure account. Then we start with the receipt and payment account, then the income and expenditure account, and then we prepare the balance sheet. So that's the first difference. Second difference, the outcome of the income statement for a limited company is either profit or loss, but for a not-for-profit organization, the outcome of income and expenditure is either a surplus or a deficit. Then in the balance sheet of a company, you will have something called equity, which is the amount that belongs to the shareholders or owners of the company. But in case of a not-for-profit organization, there is no equity, there is no capital. The balance sheet will instead contain accumulated fund, which is the total accumulated surpluses over the years, because there are no owners in the not-for-profit organization, hence no capital. Or any other point that you think is a difference, you can write. So part B. Prepare cafe trading account to find the profit or loss from the trading activity. Okay, let's see what information we have. To prepare the cafe trading account, what all information do you need? You need the revenue, you need the expenses, basically cost of sales. Revenues are not given. Are contents of cost of sales given? Yes, we have the opening inventory with the opening balance. Purchases of the cafe supplies are not given directly, but the details of payments to suppliers, opening and closing suppliers are given, so we can calculate the purchases using a purchase ledger control account format. Closing inventory is given, so cost of sales we can calculate, and they tell you that markup is 80%. So when you know cost of sales, you know that markup is 80%. You can calculate the gross profit and even the revenue from the trading activity, and then we can prepare the cafe trading account. So let's try to prepare that. I will be preparing in a rough format here just to do it quickly, but make sure you follow all the formats in the exam. Revenues, we don't know. Cost of sales, we'll calculate. Opening inventory, please don't use any abbreviations in the exam. Okay, opening inventory, if you see the opening balance is 9,500. Purchases, not given directly, but you can show a working note here. Purchases is equal to the the payments 42,000 plus the closing trade payables 13,600 minus the opening trade payables 11,400. So 44,200. From this we will subtract the closing inventory, which is given above 10,200, and then we get the cost of sales 43,500. Now we can get the gross profit, which is 80% of 43,500. $34,800. So when you know that, you can get the revenues also. 78,300. Just added the cost of sales and the gross profit. Okay, if you see the receipt and payment details, they tell you cafe wages here 22,000. These are expenses of the cafe, so will be appearing in the cafe trading activity account. So less wages 22,000. So then you get the profit from the cafe trading activity 12,800. Part B. Part C, they tell you to prepare the subscriptions account. Okay, so let's go here and try to prepare the subscriptions account. Subscriptions account, there will be balances brought down on the debit and on the credit. On the debit side, you will have the assets balance brought down. So this will be your accrued subscription at the opening. While on the credit, you will have liabilities balances brought down. So this will be your advance subscription at the opening. Okay, if you read the table here in point number 2, at 1st Jan, advance subscriptions were 8. So 8 into 200, $1,600. While arrears or accrued subscriptions 15 into 200, $3,000. Then what other transactions can we record? We can also record the closing balances. So balance carried down and balance carried down. Now balance carried down here will be the liability, and liability in case of subscriptions will be advance subscriptions. So if you look at 31st December, 11 members had paid in advance. So 11 into 200, 200. While balance carried down will be here accrued subscription. If you look at the table, 20 members didn't pay. 20 into 200, 4,000. So all of this is given till now in the table. Then now there are 2 transactions remaining. One, that you have to record how much was the subscriptions received during the year, and second, how much would you transfer to the income and expenditure. If you read the question carefully, nowhere they've mentioned how much subscriptions were actually received in cash or in the bank. So this number we cannot try to figure it figure out from the question directly. But for income and expenditure transfer, you can try to calculate, because they've given you the number of members that were using the club's services during the year, and they've also given you the subscription per member. So you can calculate how much is the total subscription based on accrual method. So 420 members were there at the opening and 18 members joined in the first half. So 420 plus 18, total of 438 members had to pay $200 subscription, while the 24 members who joined in the second half had to pay $100 each. So multiply and add these two values, you will get your income expenditure amount, which is 90,000. Because this is the amount that the club should have received from the members based on the accrual concept. So that will be transferred to income and expenditure. And now when you take the total on the debit and subtract the amounts on the credit, you will get the bank value, which will be the subscriptions received during the year. Part D, prepare the income and expenditure account. Okay, let's try to do that quickly. First, record all the incomes, then we'll record all the expenditure. So if you look at the incomes, what all incomes does the club have? First of all, subscriptions. We just calculated it in the income and expenditure, in the subscriptions account. Transfer to income and expenditure was 90,000. Then cafe trading activity, profit is there. So profit from trading, as per our trading account, if you see, profit was 12,800. So 12,800. And apart from that, let's look at the receipt and payment details, see if there is any other income. If you look at the last transaction in point number 5, receipts for hire of meeting room. So they give out the meeting room on hire and receive money. This 4,600 will be income for the year. And you look at the opening balance, income received in advance in the previous year was 2,100, which means the total income for this year 2021 is 2,100 plus 4,600. So hire of meeting room 6,700. When you add, you get the total income here. Then when you look at the expenditure, let's look at the payments. Let's begin with the payments. That's the best way to prepare income and expenditure account. Always start with your receipt and payment account. Purchase of equipment is not a revenue expenditure. It will not go in income and expenditure. We'll calculate the depreciation and put that. Club expenses, yes, 94,400 can be recorded here. No accruals or prepayments related to this. Cafe wages already taken in the cafe trading account. Final payment to hotel for annual dinner. So annual dinner expenses. During the year payment made was 16,200, but at the opening we had prepaid 4,000. That will also be considered as expense for this year. So total 20,200. Then we have depreciation on equipment. At the opening, equipment book value was 78,000. Then new equipment purchase was 14,000. Depreciation is 15%. Reducing balance. This 78,000 is already at net book value. So if you can take the total, 92,000 into 15%. 13,800. And then we have no other expense. That's it. So you can take the total. So this comes to a deficit of 18,900. Total of expenditure is 128,400 and total of income 109,500. Additional information. We are done with part D. We are going to this additional information below. Club will admit life members from 1st Jan 2023. A life membership fee of 1,500 will be payable. Explain to the treasurer how club should account for the life membership fees in the club's financial statements. So life membership fees cannot be transferred as a complete amount in the year of receipt to income and expenditure account. Why? Because the expenditure related to that life membership fees received, that will be spent by the club over a few years in the coming years. So the life membership fees also has to be divided over a certain number of years. That will depend on the policy of the club, and this is on the basis of the accruals concept. So you have to put up all this. Since it's just 3 marks, so you could say about accruals concept, you could say about a certain number of years, that will depend on the policy of the club, and you have to say that on a pro rata basis the amount will be transferred as income to the club's income and expenditure account. Then additional information, committee of the club is thinking of closing the cafe. Vending machines would be installed to provide snacks and drinks for the members. Advise the committee whether or not the cafe should be closed. Justify your answer. So what can be written for this? See, currently the cafe trading activity is in profit. If the cafe trading activity is closed down, the club will lose this profit, and eventually the deficit in the income and expenditure account will increase. So loss of profit and rise in deficit. Then we also have to see the cafe wages. Once the cafe trading activity is closed, will the staff be laid off, or will they be absorbed in the other departments of the club? If they're absorbed in the other departments of the club, their wages will still have to be paid. So wages of cafe staff, that can be a burden for the overall club, because the money or the wages will be paid from club finances, but if the activity of trading is stopped, then it could cause a burden on the finances. Then what else can we say? See, vending machines are of limited use. They can only serve the purpose of vending out certain items to the club members. But if you have an entire cafe, that creates a good impression, that creates a different impression on the members, and we can say that if we close down the cafe cafe trading activity, there could be possible loss of members, because some members might be interested in consuming the items of the cafe, or they might need those items. If these items are not there, they might also consider joining some other club. Then we can also say that since the deficit will increase here, the burden of high finance requirements may be shifted to members. How is it shifted to members? In form of higher subscription fees. So then members may not like it. So you can club this point here also. So these are all points that say that the cafe trading activity should not be closed. So you could also say 1 or 2 points why cafe trading activity should be closed, and at the end give a conclusion. So why should it be closed? Some positive points about it. So the space that was saved by closing the cafe trading activity, that space can be used in the club to provide other activities, other facilities to the members. So that can be an advantage. Once the cafe trading activity is closed, the entire club can be more focused on getting more members. So the strategies of the club can then be accordingly set. Once you've said all of this, then you can give a conclusion. If I have to give a conclusion, I would say that do not stop or do not close the cafe, and then give. So since there are 5 or 6 points written, you can justify this statement by choosing any one point. So this is how you will frame your answer. Since it's 5 marks, at least 4 points for and against, and then 1 mark finally for concluding statement with a proper logical reason. Question number 2. GPLC's financial year ends on 31st December. The financial statements for the year ended. The financial statements for the year were expected to be approved by Board of Directors. Accountant had prepared the draft financial statements which contained errors and omissions. Okay, financial statements are given. Then they have given you inventory comprised of following items: A, B, C. Cost is given, estimated selling price, estimated cost of repairs, and estimated selling expenses. So using this, we can calculate the NRV of the items. NRV will be selling price minus cost of repair minus selling expenses. So for A, it will be 98 minus 7, 92,000. For B, it'll be 14 minus 3, 11,000. And for C, it'll be 12 minus 3,500, 8,500. So if we have to choose the valuation for each category of inventory, A will be valued at cost because cost is lower, 57,000. B will be valued at NRV because NRV is lower, 11,000. And C will be valued again at NRV because NRV is lower. So the total cost of inventory, 57 plus here 19,500, 76,500. That's the total cost of total value of inventory that should be there in the financial statement. But if you see the balance sheet here, your inventory is at 80,000. So definitely we'll have to adjust the inventory later. The following items had not been taken into account fully. A machine costing 80,000 had been purchased on 1st December 2021. GPLC had paid 30,000 for the machine on 1st December and the balance was to be paid next year on 1st Feb. Only the installment 30,000 was recorded in relevant accounts. Annual rate of depreciation 15% using reducing balance has to be given. Full year's depreciation is charged. So basically out of 80,000 only 30,000 entry is done. 50,000 entry is not done. It is neither done in the asset account, neither it is done in the neither liabilities credits because it's a payment that is to be done next year. So we'll have to create a current liability for the remaining amount and you'll have to add the balance in the non-current asset also. Then adjustment number 2, a building which had cost 300,000, accumulated depreciation 96,000. So that gives us a net book value. If we subtract 204,000, that has to be revalued at 350,000. So if we compare 204 and 350,000, 146,000, this will be the balance in revaluation reserve or the credit and revaluation reserve. Okay. In December 2021, an employee filed a lawsuit against GPLC for wrongful dismissal and asked for compensation 26,000. Company's lawyer advised that the directors that there was a 80% probability of succeeding. So in case of a liability, if the payment is probable, which is the chances of paying is greater than 50%, then you will create a provision. If the chances are possible, which is less than 50%, you will disclose by way of a statement in the notes to accounts. And if the chances are remote, which is almost negligible that we will have to pay some amount, you will ignore this adjustment completely in the financial statement. So that's the rule. So in this case, if you see, they're telling you that the lawyer is advised that the payment, that 80% probability of we succeeding, it means the payment possibility is less than 50%. So this is in second category. So we will have to consider this condition and state it in the notes to accounts. We will not be creating a provision for this 26,000. The legal cost for defending the case was 8,000, which has to be paid regardless of the outcome. So this 8,000, we know that the payment is probable, more than 50% chance. We almost certainly know that we have to pay. It's just that the exact timing and the exact amount is uncertain because here they tell you about 8,000. So we can't create a liability for it, but we will be creating a provision for it. What's the difference between provision and liability? Liabilities are created for amounts that are certain regarding their time and the amount. But when the certainty is not there, we create a provision. So this provision will be created for 8,000. On 1st Feb 2022, a credit customer owing 12,000 was declared bankrupt. Basically, after the year ended, the company was informed about the bankruptcy and GPLC was advised that none of the debts would be recovered. So this becomes an adjusting event. Why? Because the debt was due on the balance sheet date. So this statement is providing you additional evidence about some condition that already existed on the balance sheet date. So this becomes an adjusting event. We will have to adjust this in the balance sheet. So 12,000 will be deducted from trade receivables. Okay. So prepare a revised balance sheet. So what I will be doing is I will just putting up the revised values of the balance sheet items here and just show you the working note. So plant, property and equipment. Number 1. What adjustments will happen? So 606,000 is the existing value. Now To this we will have to add the 50,000 installment that was remaining unpaid for machine. It was not yet added, we'll have to add it. But on this 50,000 we will have to provide 15% depreciation, 7,500. Don't do the mistake of providing depreciation on entire 80,000. Why? Because 30,000 is already recorded in the machine account, and whatever is recorded in the machine account, depreciation on that has already been provided. You only have to provide depreciation on the 50,000. And the building that was revalued, the difference between the net book value and the revalued amount will have to be added. So plus 146,000. So 794,500. That's the property, plant and equipment value. Inventory we already calculated here, 76,500. Trade receivables. Okay. Trade receivables 164,000 minus 12,000 for adjustment number 4. We discussed that it will be deducted from the debtors, so 152,000. Cash and cash equivalents will remain as it is, no change. And that's it on the asset side. Coming to the equity and liability side, 600,000 remains as it is. Retained earnings will change. Why? Because inventory valuation is there, depreciation is there, then we have the provision for the legal cost that is there, and the bad debts. All these values affect the income statement profit and hence the retained earnings. So this will 184,000. We'll say number 3. So 184,000. To this we will, or from this we will deduct the 7,500 depreciation on machine. Then we will also subtract 8,000 legal cost. We will subtract 12,000 as bad debts, and we will also subtract the fall in the value of inventory. We've reduced the value of inventory, so that will reduce the gross profit, because when you reduce the value of closing inventory, cost of sales increases and profit decreases. So minus 3,500. So our final retained earnings in the balance sheet will be 153,000. Now apart from this, you will also have to state revaluation reserve 146,000. You will have to state revaluation reserve before the retained earnings and after the ordinary share capital. Then trade payables, there will be no change. Other payables, yes, there is a change there. So 24,000. Now to this we will be adding the provision for legal cost 8,000. We will be adding the 50,000 pending installment for the machinery, since it is paid on, it's payable in 1st Feb. On 1st Feb it becomes a current liability, so other payables 50,000. So revised value of other payables 82,000. And when you then match your balance sheet, it should match. So hopefully we've covered all the items. Part B. Explain the correct accounting treatment of claim and legal cost in item 3. So for item number 3, there are two elements. One is the 26,000, which is the claim of damages on the company. For that, I told you that since the possibility of paying that amount is less than 50%, the amount will not be shown as a provision or a liability in the balance sheet. We will be disclosing it by way of notes, by way of a note in the notes to accounts. That is to be done when the payment is probable, less than 50% chance of paying. But for the legal cost, the amount has to be paid, that is certain, but the timing and the exact amount is uncertain. So we will be creating a provision for the legal cost, that is $8,000, and this is the answer for IAS 7. So since it is 7 marks, you could also mention the IAS number 37, which is on provisions, contingent assets and contingent liabilities. So that will give you additional mark. And what you can do for 7 marks is you can state the treatment, you can state the reason why it is done so, and exactly how you will go ahead in the balance sheet and show it. So when you do this for both the items along with the IAS number 37, you will get 7 marks. Part C, state what is meant by events after the reporting period. So events after the reporting period means events that take place between the year end date and the date on which the balance sheet is approved. So whatever events take place between these two dates, so in this case 31st December is the year ending date, and on whatever date the balance sheet has been approved, that is the date. So between these two dates, whatever events take place, those are called events after the reporting period. Now these events can be of two types, either adjusting events or non-adjusting events. So part number 2 says explain adjusting events. Adjusting events are events that provide additional evidence about conditions that already existed on the balance sheet date. So before this year end date, some conditions already existed. It says that the event that has happened after the year end date, it's just providing you additional evidence about that. So such events become adjusting events, and these events have to be adjusted in the financial statements. Non-adjusting events are completely new events. Conditions that they have created, these events have created, they were not existing on the balance sheet date. Hence, these are not adjusted in the financial statements, and these are called non-adjusting events. Question number 3. Your summarized statement of financial position of EPLC is given. Further information is also given. Equity at 31st December 2020, which is opening. Opening details of equity are given. Ordinary share capital, share premium, retained earnings. Okay. On 1st Jan 2021, EPLC made a 1-for-8 bonus issue. It is the company's policy to keep the reserves in the most flexible form. So when they tell you what order will you use the reserves to issue the bonus shares, first you will use share premium balance, if any, and then only you will go ahead and use general reserve, retained earnings, so on. Interim dividend of 0.3 per share was paid on 1st August. Proposed dividend of 0.25 was declared on 31st December 21. Okay. At 31st December 21, market value of one share was 4.52. General reserve was created on 31st December. Okay. Prepare a statement showing the movement of retained earnings for the year ended 31st December. So the statement of changes to equity, but only the retained earnings section. I'll just do it very briefly here. Opening balance. Information number 1, opening balance is 204,000. Then we have the issue of bonus shares. Now bonus shares were issued on the basis of 1 for every 8. So this 400,000 shares divided by 8 gives us 50,000. But this 50,000 has to be done keeping the reserves in the most flexible form. So share premium will be used for 44,000 because that's the balance available on 1st of Jan on the date when bonus issue was made, and the remaining 6,000 will be taken from retained earnings. So in the retained earnings column only minus 6,000. Then interim dividend of 0.3 per share was paid. So interim dividend paid 0.3 per share. How many number of shares were there on 1st of August? 450,000 shares into 0.3, 135,000. So minus 135,000. Proposed dividend will not be entered here. Last year's dividend is not given, else we would have recorded that here. Final dividend paid but not given. Market value of one share is irrelevant for this. General reserve, if you look in the balance sheet, is 30,000. They tell you that this was created in the current year. So transfer to general reserve 30,000. And they give you the closing balance. As per balance sheet, it is 231,000. So there has to be some item here that leads to 231,000 closing balance, and it is obvious if you have prepared statement of changes to equity or you've done such questions enough number of times, you would realize that profit for the year is missing. So it should click in your mind that the balancing figure has to be profit for the year. They've not stated it directly here that you have to put the profit for the year as the balancing figure, but it has to come naturally in your mind. So profit for the year, when you calculate, you get 198,000. Part B, calculate to 2 decimal places the following ratios. Okay. Price to earnings ratio, the formula is the market price of the share divided by earnings per share. Earnings per share is not directly given, but can we calculate earnings per share? Yes, we can calculate earnings per share is equal to the total profit earned during the year, which is 198,000, divided by the total number of ordinary shares, 450,000. So we get $0.44 per share. And now we can calculate the PE ratio, which is market price $4.52 divided by $0.44 EPS. So 10.27 is the PE ratio. Dividend yield. So dividend yield will be the total dividend declared, which is interim plus final, the total of interim and final dividend divided by the market price of the share. Now, why is it divided by market price? Because they are telling you to calculate dividend yield. Yield means when you make an investment, how much percentage return are you making on that investment? So market price of the share is what the investors have invested in the share, or anyone who buys the share today will have to invest in the share. And when you take the dividend and divide it by the market price, basically you're calculating what percentage of the investment made in the share is being received as dividend, and that is the meaning of dividend yield. So interim dividend is 0.3, final dividend is $0.25 per share divided by market price 4.52, so 12.17%. Then we have the gearing ratio. So the formula for gearing ratio, okay, let me do it here. Formula for gearing ratio is the capital on which we have to pay a fixed percentage cost. So fixed cost capital. This will include your loan, debentures, or even preference shares on which a fixed rate of dividend is paid, divided by the overall capital employed in the business. Capital employed will be equal to all your non-current liabilities plus all your equity. So this will include your fixed cost capital plus all the ordinary share capital also. So fixed cost capital in this case is only debentures, which is 150,000, and capital employed is 150,000 debentures plus 711,000, which is total equity, and when you divide this you will get 17.42%, which means 17.42% of the total capital employed in the business is the fixed cost capital on which the company is paying a fixed percentage of interest. Then number 4, income gearing ratio. Which is equal to the interest cost divided by the profit from operations or operating profit. Basically, what percentage of the operating profit is being used to pay the interest. So interest expense is 9% debentures into 150,000, so $13,500 divided by profit from operations is not given directly, but you have the profit for the year. Profit for the year is 198,000. If I add back the interest that I calculated, I will get my profit from operations. So 198,000 plus 13,500 and the whole thing multiplied by 100. So the income gearing comes to 6.38%. Okay, then we have return on capital employed, which is equal to operating profit or profit from operations upon total capital employed multiplied by 100. Operating profit we just calculated, the total of the denominator, which is 211,500, and capital employed also we calculated in the gearing ratio, which was $861,000. So you will get your return on capital employed. Question number C, explain what is meant by a highly geared company. So in part number B, number 3, gearing ratio we calculated. So this is in reference to that. When you call a company as highly geared, when the element of non-current liability like loan, debenture is very high compared to the overall capital employed. So a highly geared company is a company wherein the element of debt or element of fixed cost capital is much higher compared to its overall capital employed, or compared to the equity part. The overall debt is much higher. Such a company is called a highly geared company. Since it is 2 marks, you could also add that a highly geared company would mean high reward to the shareholders, but it also means that it carries a high element of risk. Additional information: at 31st December 2020, the market value of the share was 3.64. So at the opening, basically opening date of the year. And the PE ratio, price to earning, was 9.27. Explain the change in the price earning ratio with reference to the PE ratio we calculated above. When we calculated PE ratio above, it was 10.27. Now it is 9.27. Basically the PE ratio is increasing at the closing compared to the opening. Since the question is for 3 marks, we could start by first calculating the EPS at the opening. PE ratio is equal to the market price upon EPS. So if you want to calculate EPS, we could change the equation and say market price upon PE ratio. So 3.64 divided by 9.27. So we get a EPS of $0.39. So 0.39. This when compared to the closing EPS. So closing EPS is better compared to the opening EPS. It means, so here the company has performed better when it comes to earnings. So in spite of EPS increasing, the PE ratio has increased. Okay, understand this. PE ratio is equal to market price of the share upon EPS. If EPS has increased during the year, it means PE ratio should have fallen because denominator is increasing. The overall formula should have fallen. But why is the overall formula PE ratio increasing? Because market price has increased in a higher proportion compared to the EPS. So market price has risen higher or in higher proportion. This indicates that shareholders or investors are more confident about this company compared to earlier, because now they're willing to pay a higher price for the shares of this company. So it indicates higher confidence. So for 3 marks, you can write all this. On 1st Jan, EPLC had an opportunity to invest 150,000 in a new project. The directors had 2 options. They could issue 9% debentures for 150,000. They could also issue additional ordinary shares. The directors chose option 1. Okay, they took debt, which is also evident in the balance sheet. And the new project contributed pre-interest profit of 70,000. So basically this option increased the operating profit by $70,000. Assess whether or not directors of EPLC made the correct decision in issuing the debenture. So let's see what all points can we write. It's 5 marks. First, I mean, it's you could use 2 or 3 points just as a comparison between debt versus equity. What are the points that you can use to compare debt versus equity? So this here you have to pay a fixed rate of interest, but it has to be paid mandatorily whether you make profits or not. So principal and interest has to be paid on time, whereas in case of equity, there is no commitment to pay any dividend or no commitment to return the capital. So you could use these as 2 points. Then 1 point you could also write that there is no dilution of ownership. The existing owners continue to share the profits in the same way, but when you issue additional ordinary shares, there is dilution of ownership, which the existing shareholders may not like. They may not be in favor of this. Then you could also show the calculation of EPS if option 2 was selected. If option 2 was selected, what would be our revised EPS? Our profit from operations wouldn't change. It would be 211,500 only. because whether you take the money from option 1 or from option 2, your profit from operations will not change, but the number of shares in the denominator will change. Earlier we had 450,000 shares. To this we will have to add additional 120,000 shares. So if you calculate the revised EPS, it comes to 0.37. In case of option 1, what was the EPS? It was $0.44. So if you see, the EPS per share is reducing, which is not favorable for the existing shareholders. So you could use this point also as a comparison. And finally, conclusion. I would conclude that debt is better because this company is not even highly geared. The debt as a percentage of the capital employed was just, we calculated gearing ratio here, 17.42%. So which is not high, up to 50% is still okay. So since the company is not highly geared and there are some drawbacks of issuing additional ordinary shares like dilution of ownership, fall in EPS, so it is better that option 1 is a better choice, and hence the decision was correct. So 1 mark for this. Then we have question number 4, which is on joint venture. I'm not going to solve joint venture question here because joint venture is completely removed from syllabus for AS&A level. So I don't expect it to be included also anytime in future. So I'm not going to solve this question. But I have videos on joint venture and consignment in the financial accounting playlist. Yes, you can refer to that if you want to learn how to do these questions. Going to question number 5, which is on costing. T Limited produces 2 products, product S and product P. The budget information for the 2 products are given. Quantity is given. Direct material cost is given. Okay, material per unit requirement 1 kilo and 2 kilos. The material cost per kilo is given for both the products. Labor requirement in hours is given. Hourly wages are given. The budgeted factory overheads are 465,000 for the year. Directors use direct labor hours as a basis, okay, to calculate the overhead absorption rate. They use denominator as budgeted direct labor hours. The markup for both products is 50%. In part A, prepare a statement to calculate the selling price per unit for product S and P. It should also show the total cost per unit. So obviously for calculating selling price, you need the total cost. So in your statement, you will have to show the total cost for both the products. On that, add up 50% markup, you will arrive at your selling price. So what will be the total cost? Total cost for each of the products will be direct material plus direct labor plus your overhead cost. Direct material, let's say for product S, it will be 1 kilo into $8, while for product P, it will be 2 kilos into $8.5. So $8 and $17. When it comes to direct labor, 4 hours into $15 per hour, $60 for product X, 6 hours into $18, which is $108 per unit. So that completes direct material and direct labor. Now for overheads, you will have to first calculate the overhead absorption rate because the overheads are totally 465,000. This has to be distributed between the 2 products using the direct labor hours. So overhead absorption rate is equal to budgeted overheads, which is $465,000 divided by the total labor hours that are expected. For product S, you need 24,000 units and each unit takes 4 hours. And for product P, you need 15,000 units. Each product needs 6 hours. So 465,000 divided by denominator will be 186,000 hours. So $2.5 per hour, per labor hour. So now when you get this for product S, you will have to calculate your overhead cost as 4 hours taken into $2.5. So $10 for product X. For product P, it will be 6 hours into $2.5, $15. So what will be a total cost for product S? It will be $8 material, $60 of labor, and $10 of overhead. So $78 total, plus on this profit element, you'll have to add 50%, which is $39. So your total selling price will be $117, and the same way you'll also have to show for P. You could present it in form of a statement. S and P, show all the items. It'll save time and it looks better when it comes to presentation. Additional information: management accountant has suggested that the activity-based costing should be adopted and provided an analysis of the budgeted annual factory overheads. Total overheads are 465,000 that they told us above, but now they've given us a breakup. How have they divided it, or what are the elements of this overhead? And with each of these elements, they have also suggested what are the cost drivers that drive these costs. Explain what is meant by the term activity-based costing. Activity-based costing is a concept, is a process wherein the overheads are divided into cost pools, and each cost pools are associated with certain cost drivers that drive the cost. Then these overheads are charged or absorbed by the products based on how these products have used the cost drivers or have consumed the activity. So whichever product is consuming more activity, it means they are leading to more overhead, so more overheads will be charged to such products. Versus in the traditional overheads, in the traditional absorption costing, what would we do? We associated overheads with labor hours, and these labor hours are the time taken to produce the product, but not necessarily that a product that takes more time to be produced by labor leads to higher overheads for the business. So that is the difference between absorption costing and overheads costing. But in part B, you're just supposed to explain the meaning of activity-based costing. Since it is 3 marks, it'll be good if you explain it properly. Part C, prepare a statement to calculate the selling price per unit of product S and product P by using activity-based costing. Okay, the statement should also show the total cost in terms of dollars, the total cost for the overall production, and also the total cost per unit. Okay, so this can also be done in form of a statement. So we have two products, S and P. So we can say, let's say output on top. In terms of units, we have 24,000 and 15,000. The direct material cost, so you could take 24,000, multiply it by 8 and write it here. 15,000 into 17, you could write it here. Then you have direct labor cost, 25,000 into 60, sorry, 24,000 into 60, and 15,000 into 18 into 6, 108. And then it comes to overheads cost. So under overheads cost, what you could do is you could say 4 types of overheads: purchasing material, machine running, machine setup, and inspecting. And how will you divide these between the products based on their usage of the cost driver or usage of the activity? For example, purchase material cost overall is 120,000. Now this 120,000 purchasing materials, the main driver that drives this cost is the number of orders made or number of purchase orders that were made. Now from side of product S, 24 orders were raised. For product B, only 8 orders were raised. So for product S, it will be 120,000 into 24 divided by 24 plus 8, 32. While for product P, it is going to be 120,000 into 8 by 32. Basically, you have to divide these costs proportionately between S and P based on the usage of the cost driver. And then you get the total cost here. Then you take a total of all these costs, write it here. Then you can divide the total cost that you get. You can divide by the output on top. So cost per unit you will get. To this you will add your 50% markup as usual, and then you will get your selling price. So that's the concept of activity-based costing. Part D, advise the directors whether or not they should adopt activity-based costing. Support answers with reference to A and C. Okay, if you compare A and C, obviously there is a difference the way in which overheads are absorbed under absorption costing and activity based costing. Because of this, the cost changes. Because of this, the selling price changes. So you could write this so that the cost is more realistic when it comes to activity based costing. Hence the selling price is more realistic and competitive in the market when it comes to activity based costing. So these are the advantages of activity based costing. One more advantage of activity based costing could be that when you divide your overall overheads into these activities and understand these activity costs based on some cost drivers, you also get an opportunity to control these costs in future. So it helps in better control of cost. So all these are advantages of activity based costing. Then you could suggest some disadvantages. See, when you get your selling price as per A and selling price as per B, you have to see the difference. Is the selling price of the product really different when it comes to activity based costing? If yes, then probably the change to activity based costing will be justified, because when you implement activity based costing, it involves a lot of cost. Basically, a lot of administrative expenses are involved because you need separate staff to monitor the cost drivers, have a count of the cost drivers. So you have to see whether the new selling prices that we get under activity based costing, how different are they from the old ones. So the change or the difference, if it is too high, then only the extra cost that you spend on implementing the activity based costing system, that is justified. Otherwise, for small businesses, they can also ignore the activity based costing. After all of this, you can then give a conclusion. Either of the conclusion should be okay. For me, I would compare the selling prices under B and A. If there is a lot of difference between the selling prices of the products, then I would say yes, one should go ahead with implementation of activity based costing. Otherwise, if the difference is not much in the selling prices per unit of A and B, I would say the company may even choose to not implement because of high cost, and that's it. Yeah. Now let's do question number 6. P Limited makes one product. It adopts absorption costing and operates a system of standard costing and budgetary control. Standard costs and budgeted information is given. So budgeted production and sales 6,000. So they estimated that they would produce 6,000 units during the period. And selling price is given. Direct material cost is $6 per unit. And for that they will be consuming 4 kilos of raw materials. So 4 kilos multiplied by $1.5 per kilo. That's how we get $6 per unit. And direct labors 3 hours takes $36 per unit, or it costs the business $36 per unit. So it means the breakup is like 3 hours into wage rate is $12 per hour. So that's the cost. Okay, fixed overheads given 72,000. It is absorbed on the basis of direct labor hours. Part A, calculate the budgeted profit for the budgeted sales of 6,000 units. So to calculate the budgeted profit, we will be using quantity of 6,000 and we'll be using the standard data, standard selling price, standard cost. So profit statement. Beginning with the revenues, 6,000 into 70, 420,000. Then we have direct material cost, which is 6,000 units into $6 per unit, so minus 36,000. Then direct labor cost 6,000 units into $36 per unit, so 216,000. And fixed overheads, which is 72,000. So budgeted profit is $96,000. Part B, okay, before that, additional information. Actual results for April were as follows. Production and sales 5,800, so actual output is this. Then actual selling price is given, material cost is given, labor cost is given, and actual fixed overheads are given. Fine. Calculate the following variances. So if you remember from the variance chapter, as I told you, variances are always calculated by comparing the standard data and the actual data. Now actual data, in other words, actual revenues, actual cost is given, but we don't have the standard cost, the standard revenue that we don't have. we will have to make that calculation. How do you calculate the standard data? We will have to apply the standard selling price and standard cost price on the actual output. So what I'm going to do is, for now, I'm just going to do it as an extension here to save some space. But in exam, you can do this as a separate working note, so that calculation of variances is very easy for you. So standard and actual. Now for revenue, what I'll do is I'll take 5,800 units, multiply it with the budgeted selling price of 5,800 into $70, which is 406,000. Direct material cost, 5,800 units into $6 per unit, 34,800. Then direct labor cost, 5,800 units into $36 per unit, 208,800. And fixed overheads. Fixed overheads are absorbed on the basis of direct labor hours. So there are two ways of doing it. Let's say you try to absorb the overhead based on direct labor hours. So for that, you will have to take in the numerator budgeted overheads, and the denominator you'll have to take the total labor hours required to complete the production, which is 3 hours into 6,000 units, 18,000 budgeted labor hours. So that gives you $4 per hour is the overhead absorption rate. Now every product takes 3 hours to be completed, so the overhead absorption for every unit of output will be $4 per hour into 3 hours, which is $12 per unit. That is the rate at which we are going to absorb the overheads. So when you produce 5,800 units, how much are you going to absorb in total? $12 into 5,800. So 69,600. Now there is also an alternate way of doing this. You can directly take 72,000 divided by 6,000 into 5,800. Why am I taking output in the denominator? Because here it says that absorption is to be done on the basis of direct labor hours. Then can we take output in the denominator? Yes, you can take, because there's just one product. Let's say if there are multiple products and each product takes different time to be produced, every unit, the time taken to produce every unit of the different products is also different, then you cannot take the output directly in the denominator. In that case, it is mandatory to use labor hours. But when there's a single product, whether you use labor hours in the denominator and then convert it into dollars, the overhead absorption rate per unit, or you directly take output, it doesn't make a difference. So you'll get the same answer. So standard profit here, 92,800. We'll also need actual data. Actual revenues is 5,800 into $72 per unit is the selling price of 417,600. Material cost is given as 35,113. Labor cost is given as 221,760. And factory overheads actual is given as 70,400. So when we calculate the actual profit, it comes to 90,327. Now it is easy to calculate the variances. Let's see how we'll do it. First, calculate the sales price variance. So the formula for sales price variance is the difference between the actual selling price and the standard selling price or the budgeted selling price multiplied by the actual quantity sold. So $72 minus 70 into 5,800, so that gives us 11,600. Will it be an adverse variance or a favorable variance? See, the actual selling price is higher than the estimated selling price, so we've been able to earn more revenues because of this higher selling price and higher profit also, so favorable variance. Second, calculate the sales volume variance as a measure of change in profit. What do you mean by this last part, as a change in profit? Let me explain it to you. First of all, what's the formula for sales volume variance? Difference in the volume, so actual quantity minus budgeted quantity. Now here, there are two ways of calculating the sales volume variance. In fact, there are two accepted ways of calculating the sales volume variance. Either you can multiply it by the standard selling price, or you can multiply it with the standard profit per unit. So this question clearly tells you that use the change in profit. So we are going to use the second formula, which is standard profit per unit. The actual quantity 5,800, budgeted quantity 6,000. Now how much is standard profit per unit? See, the budgeted profit that we arrived or we calculated at in the budgeted column was 96,000. This 96,000 is for 6,000 units. So for every unit, it was budgeted that we will be earning $16 per unit. So 3,200. Adverse, because the actual quantity sold is less than the budgeted quantity. Less quantity sold means less profit. Then we have the direct material total variance, basically total direct material variance. So the direct material variance is nothing but the difference between standard cost minus actual cost of material. Had you not done this working, standard and actual working as a working note, then you'll have to do the detailed calculations here, but we've already done the calculation. We've prepared the working note, so we can just take the difference between standard and the actual of material, 34,800 and 35,113. So it comes to $313. Since actual cost is more, it becomes an adverse variance. Then the next one, they want us to calculate the direct labor total variance. This is also similar to the total direct material variance, where we will be taking the standard cost of labor minus the actual cost of labor. We've already calculated the numbers here. So when you take the difference, 208,800 minus 221,760, we get a variance of 12,960 adverse, because actual cost is higher. Then we have the fixed overhead volume variance. So whenever it's about volume, variance is about volume, you can always take the difference in the quantity in the bracket and then multiply it with the overhead absorption rate per unit. Actual quantity minus budgeted quantity, we already know it's the difference is 200 units, and overhead absorption rate also we calculated here when preparing the when we were calculating the fixed overheads for the standard column. So we calculated it as $12 per unit. So we're going to use the same $12 per unit here. So $2,400. Now think for yourself whether this will be an adverse variance or a favorable variance. What mistake students do normally is they will feel that since the quantity, actual quantity is lower, so this $200 is multiplied by the fixed overhead cost $12. Since the actual quantity is lower, it turns out to be that the fixed overhead cost is also lower for the business, and they end up putting this as a favorable variance. That is not the correct way of thinking. See, the fixed cost has to be paid whether you sell budgeted quantity more than that or less than that. But the more you produce and sell, the more you are going to absorb, and you are going to collect it from your customer. You're going to recover the overheads from your customers. So it is always better that actual quantity should be higher than the budgeted quantity. In this case, actual quantity is lower than the budgeted quantity. It means that we have been able to recover or absorb $2,400 less. So that becomes an adverse variance. And then we have the last one, fixed overhead expenditure variance. Which is the difference between budgeted overheads and actual overheads. Why? Because when it comes to fixed overhead expenditure or spending variance, we are trying to understand how much more money or how much less money is spent when the expenditure was being incurred during the year. So you already budgeted some fixed overheads for the year. If you pay exactly equal to what is budgeted, there is no variance. But if you pay more than the budgeted variance, budgeted overheads, you are paying more, your cost is higher, so that will be an adverse variance. And if you are paying less than the budgeted overheads, you will be having a favorable variance. For example, if you take rent, if you estimated that your annual rent is going to be 100,000, it should not change. The moment it changes, let's say it becomes 110,000, it means you've not been able to get a good bargain for the premises or for the property, and that is why this is a part of spending variance or expenditure variance. So budgeted overheads was 72,000, actual 70,400. So here the business has been able to save $1,600. Basically I've taken the difference between this and this. So favorable, because actual spending was less than what was budgeted. So this completes a calculation of the 6 variances they've asked for. Additional information: the management accountant is going to perform variance analysis. The actual labor hours used were 17,600. So these are hours. Explain the likely causes of sales volume variance calculated in B part 2. You see the sales volume variance here, $3,200. They are telling you try to tell causes of these. Now since it's 3 marks, let's say we can state 1 or 2 causes and explain it, or we can also state 3 causes to be safe. So when volume variance, sales volume variance is adverse, it means you're able to sell lesser quantity compared to what was budgeted. Why will a business be able to sell less quantity? Logical reasons. Maybe because the selling price is higher compared to competitors. Maybe the quality of the product is poor compared to what is available in the market. We can say ineffective advertisement or marketing campaign. You could also state one of the reasons that overall low demand in the market. Maybe the economy is going through a recession or something of that sort. So the overall demand in the market is less, and hence the actual quantity sold is less. So low demand in the market. Any 2 or 3 reasons you can state, you can explain it. So that is for C part 1. Now going to part C2, where they tell you to explain the causes of direct labor total variance. See, the direct labor total variance is $12,960. They're telling you explain the causes of this. Let me take this here. So direct labor variance, in total it is 12,960. They are telling to explain the causes of this. Labor variance can happen due to 2 factors, either due to a change in the efficiency of labor, the speed at which they are producing the products, and the wage rates of the labor that is working. So labor rate. So if we are able to calculate these sub variances of the total direct labor variance, we will be able to explain that what is the cause of this 12,960 adverse variance. Now, what are they telling you? That the actual labor hours used were 17,600. We will be using this. So let's try to first write down the formula for the sub variances. Efficiency variance, if you want to calculate, you will have to take the difference between standard hours taken to produce the actual output minus the actual hours, standard hours that should have been taken to produce the actual output minus the actual hours that have been taken, multiplied by the standard wage rate. So standard hours taken to produce the output multiplied by the standard rate, I'm just opening up the brackets, minus actual hours multiplied by standard rate. I've just taken this and multiplied by these two. Now standard hours multiplied by standard rate is nothing but the standard cost of labor, 208,800. So 208,800 minus the actual hours is 17,600 multiplied by the standard wage rates that were budgeted initially were $12 per hour. So multiplied by $12. So 2,400 adverse. There's an alternate way of also doing this. If you don't want to actually open up the brackets and do it in this way, there is another way of also doing it. Let me show you that also. The standard hours required to produce 5,800 units of output will be 5,800 into 3 hours per unit. So 17,400 is the standard time that should have been taken. Actual time taken 17,600. We can take the difference, multiply it with $12 per hour. That's the wage rate, standard wage rate. So 200 into $12, 2,400. This is also an alternate way of understanding and doing it. Adverse variance. Why adverse? Because actual time taken is more than the standard time. And for wage rate variance or labor rate variance, we will take the difference between standard wage rates versus actual wage rates and multiply it with the actual hours taken to do the job. Standard rate is $12. Now, how will you calculate the actual rate? See, actual wages are given as 221,760 and actual time taken is 17,600. So doing this calculation, 221,760 divided by 17,600, $12.6 per hour. That's the actual wage rates. So this we will take in the formula here, multiplied by 17,600. So the difference $0.6 into 17,600, 10,560 adverse, because actual wage rates are higher than what was estimated. So the wage rates paid to labor is higher. So the human resource department has not been really efficient in sourcing labor at a cheap price. So now the question is, explain the causes of the total direct labor variance. So you'll have to explain, or you have to state that the total direct labor variance is $12,960 adverse, and that is because of inefficiency of labor that caused a variance of 2,400 adverse, and the labor rate variance, which means that the wage rates paid to the labor were higher, and because of that the variance cause was $10,560. Then we have the additional information. By analyzing the direct material total variance, the direct material usage was found to be 1,275 adverse. Okay, usage they've given you 1,275. Assess whether or not the company has been successful in controlling the direct material price variance or cost price variance. See, if we take down the total direct material variance, which is $303 adverse, we can divide it into either usage variance or cost price variance or material price variance. Now usage variance, they are telling you that it is 1,275 adverse. If the total is 313 adverse, usage is 1,275 adverse, so material price variance has to be the difference, which is 962 favorable. Then only you can take a net of this and get 313 adverse. So I got 962 as 1,275 minus 313. So now that you know that material price variance is favorable, 962, what can you comment about the control over direct material cost price variance? So you can state that the business has been effective in controlling the cost of raw materials because there's a favorable variance. They've been able to source the raw materials at cheaper price compared to what was budgeted. So that completes our question number 6. Now let's start with paper number 32. Question number 1. MN Drama Club was formed in 2017 with the objective of promoting modern performances. The treasurer of the club resigned on 31st December 2021. The chairman prepared a draft income and expenditure account which was based on the receipts and payment account. So basically the treasurer of the club who is resigned has prepared based on receipts and payments. It means it's prepared on cash basis, not on accrual basis. So the draft income and expenditure looks like this. Basically these are all the items of receipts and payments, but he's prepared in an income and expenditure format. So we have the subscriptions received, tuition fees, ticket income from performances and donation, and on the payment side we have expenses for performances, office equipment, which is a capital expenditure, administrative expenses, heating and lighting, building extension and building maintenance. Building extension is also a capital expenditure. Office equipment is also a capital expenditure. Donation is a revenue receipt or a capital receipt. It depends. We'll have to see some additional information is given or no. Let's say no information is given about donation, then you will treat it as a revenue receipt and put it in the income section of the income and expenditure account. Then the draft income and expenditure account has been present to a member of the club who is an accountant. Fine. Further, following information is given. There is great demand for after-school tutorial classes in the local community. In October 2021, the club started running after-school tutorial classes. The club targeted the classes at children from poor families. Maximum of 20 children could join these classes. The children were required to join as student members of the club and pay the following in advance. A student membership fee of $100, which is 1/3 of the ordinary membership subscription. So the ordinary membership subscription becomes $300 per member, while the student membership is $100 per member. And apart from that, they have to pay a tuition fee of $400 covering the period October to May. If you count this period, it is 8 months. So the per month tuition fees would be 400 divided by 8, $50. Then student membership fees paid by children are included in subscriptions in the draft income and expenditure account. So basically this subscriptions here, 40,400, this consists of student membership, and it is $100 and 20 students have paid. So 2,000 out of this is the student membership fees. Okay. And the tuition fees is refundable on a monthly basis. The tuition fees that you see here, 8,000, 20 students had joined and each student had paid $400 as per the adjustment number 1. So that gives us 8,000. Fine, that is also matching. Then the tuition fees is refundable on a monthly basis. If the student withdraws, student membership fees is non-refundable. Okay. The tutors. Okay, before that, what is the importance of this statement? The importance of this statement is that once you receive the student membership fees and it is non-refundable, so you can treat it as complete income for this period. You don't have to divide it, or you don't have to count how much is the prepaid receipt for it. But when it comes to the tuition fees, since it is refundable, we will only treat that part of the tuition fees as income which falls in the current year, because for the next year going forward, some members can also demand back or ask for a refund of the student membership fee. So we can't record that as an income in the current year. So that's the importance of the statement. The tutors are volunteers and have experience in teaching. Fine, the classes were popular and fully booked. So the importance of this statement is that we will be counting 20 students in all our calculations. Okay, so the subscriptions, we said that 2,000 out of this is the student membership subscription. So the remaining 38,400 will be your ordinary members subscription. Tuition fees, okay, it's 8,000. Now out of this, how much is for the current year in the income and expenditure account will we take? Only 3 months. So 8,000 divided by 8 into 3,000. October, November and December. And the remaining 5 months, Jan to May, that will be recorded as a current liability, prepaid income, 5,000. Then if we also see the ticket income from performances, 14,200, and here we have expenses for performances. What we are going to do is we are going to record the net of this as the net income under the income section. We are not going to record them as separate. And for the other items, let's see if we have any more adjustments given. Information relating to ordinary member subscription on 31st December 2021 and 2020. Basically opening and closing is given here. So this is the closing, this is the opening. Okay, prepaid and accruals are given. Okay, and when counting the amount, we will be taking $300 per member. Information relating to non-current assets, cost at opening, basically since 31st December 2020, these are the opening cost, opening accruals. Then they're telling you building will be depreciated by straight line and equipment will be depreciated by reducing balance, 10% and 20% fine. Full year's depreciation is charged in the year of purchase. Okay. An item of office equipment was purchased on credit. The debt was repayable in 3 equal installments at intervals of 4 months. So 3 installments it has to be paid, with the first installment being paid in October 2021. So if you go back to the payment section here, it says office equipment first installment 2,000. So this is just the 1/3 of the overall cost of equipment. So 6,000 will be the total cost of equipment, and the remaining 4,000 we will be showing it as a liability in the balance sheet. Then during the year, a member donated 7,500, which is to be used to sponsor club's participation in a national event for coming 5 years. This becomes a specific donation. So donations are of 2 types, general donation and specific donation. General donation, where the donor does not specify the use of the money of the funds, that is called a general donation, and that you can treat it as a revenue receipt and put it in the income and expenditure account. But specific donation is when the donor specifies a purpose. We will be transferring only that part of the donation to the income and expenditure which is used for the specific purpose. But in this year, no amount is used for that specific purpose. So the entire donation amount will be a capital receipt and it will not be transferred to the income and expenditure account as an income. Other prepaid and accrued expenses at 2021 and 2020 are given. So again, closing and opening, admin, heat and light, and okay, first two are accrued, then prepaid, heat and light. Okay. Cash at bank at the end is given 6,400. Okay. State 2 reasons why a club needs to have a clear objective. There can be many good points that you can write for this. First of all, it helps the club to use the resources efficiently. So efficient use of resources. Club will also be having a constraint on the resources, on the assets they have, on the money they have, on the funds they have. So if the objective is clear, they can work towards that objective and make sure that all the resources are used in the efficient manner. It also helps in giving clarity to stakeholders. Who are stakeholders? Stakeholders could be anyone associated with the club. It could be donors who are donating money to the club because they are under an impression that our money will be used for a certain purpose, for a certain objective of the club. Stakeholders could be members who join the club for a purpose, because their purpose is linked with the objective of the club. So it gives clarity to stakeholders like the members who join by paying a subscription or donors who donate for a certain purpose. So when the club has a clear objective, these are the advantages, or you could write any other suitable point. Then part B, explain how the $8,000 of tuition fees will be treated in the revised financial statements. So as we discussed, in the income and expenditure account, and in that the income section, we will be recording $3,000 as income, and in the balance sheet under the current liability section, we will be showing as payable as advance income $5,000. And what is the basis of this? The basis of this is the accruals concept. So as per accruals concept, only the income or expense that is for the current period will be recorded in the income and expenditure account, irrespective of actual receipt and actual payment. So all of this you can write, show the amounts, and I think this should be okay for 4 marks. Then prepare the revised income and expenditure account for the year ended 31st December 2021. Okay, let's try to quickly do it. First, we will focus on the incomes. So going back to our draft income and expenditure account, what all incomes do we have? We have subscriptions. Now out of this 2,000, we said that as students member subscription, and the ordinary member subscription is 38,400. We'll record them separately. But these 38,400 subscription, this is subscriptions received. To this, we'll have to make the accrual and prepaid adjustments. So we'll come here and say subscriptions, ordinary members, and students. For students, it is clear, entire 2,000. For ordinary members, let's do a working note, 38,400. To this, if you see adjustment number 2, closing accruals, which is 24 members into $300, 7,200 we will add. And at the closing, there are no advanced subscriptions, so nothing will be subtracted. And at the opening, we have prepaid subscriptions or advanced subscriptions that will be added, 2,700. And the accruals at the opening, which is 4 members into 300, 1,200 will be subtracted. So when we count this, so 47,100 ordinary member subscription. Apart from this, what all do we have? We have Ticket income from performances 14,200, and we will subtract the expenses for performances. So, ticket income 14,200 and 11,500 less expenses. In exam you'll write the whole thing, expenses for performances. So 2,700. And apart from this, we'll also have to record the tuition fees, as we discussed, 3,000. So total income for the club will be 54,800. Then we'll have to deduct all the expenditures. What all expenditures do we have? We have expenses for performances we considered. Office equipment is a capital expenditure. We'll consider the depreciation. Admin expenses we have. Heating and lighting we have. Building extension is a capital expenditure. We will consider depreciation. And we have building maintenance. So let's record these three expenses first. Admin expenses, heating and lighting, and we have building maintenance. For building maintenance, there are no adjustments, so we can directly record the amount, which is 4,600. For heat and light, we have to do some adjustments for accruals and prepayments. If you see adjustment number 5, so as per the receipt and payment, heat and lighting is 13,200. So let's say number 2. Heat and light 13,200. Accruals at the end is 0. Accruals at the opening is 1,500, so minus 1,500. Prepaid at the end is 700, so minus 700, and no prepaid at the beginning, so 11,000. And admin expenses, number 3. As per the receipt and payment, it is 30,100. To this, closing accruals we will add, opening accruals we will subtract, and no prepayments. So 33,000. Sorry, 32,900. Now we have depreciation on equipment and depreciation on building. So let's call this number 4 and number 5. Okay, for equipment, if you see 120,000 is the opening equipment and accumulated depreciation is 85,000. But if you remember, we had purchased $6,000 worth of equipment at the during the year, sorry. So 120,000 plus 6,000 minus 85,000, the whole multiplied by 20%. So we get 8,200. And for building, 200,000 plus the building extension was 16,000. So 200,000 plus 16,000. Since this is straight line, we on cost we are going to take 10%. So 21,600. So 8,200 and 21,600. Taking the total of expenditure 78,300, and then we get the deficit minus 23,500. Then additional information: the chairman has received many requests from local parents for the tutorial classes because the fee charged by the club is 50% lower than the other organizations. He has a plan to admit 60 students in October. To increase the capacity, he estimates that an expenditure of $30,000 would be required in the extension of club's building. Advise whether or not he should be carrying out this plan. justify answer, and for 7 marks. So you could divide your answer into two aspects. One is the financial aspect, and then we have the non-financial aspect. Financial aspect, if we spend $30,000, we can say that we will be earning revenue from the tuitions, from the 16 students that can be admitted, not only in the current year. That facility can be used in the coming years also. So there is a good amount of revenue that can be generated from this facility. Then second aspect of the financial point is that the 30,000 that they want to spend, you also have to see that they've given you the cash balance at 6,400, which is not required as such in anywhere in the question, but they've given you, probably you could say that the club does not have sufficient cash to spend this, so they will have to go for some kind of borrowing, maybe a long-term loan or an overdraft facility, but that will have some interest. It will lead to additional burden for the club. If the club is not able to generate sufficient income from the students, then this burden will have to be borne by the club. It will be difficult for the club. So these are the financial aspects. Non-financial, so you can say that it'll create a good name for the club, because the club is giving a good service at a lower rate. So once the popularity of the club is increased, then ordinary members or some other people can also join the club. The club can receive more donations once the people know that it has a certain objective. So these non-financial aspects also you can speak about, and then give a conclusion at the end. So I would conclude by saying that yes, the club can go ahead with the plan, and obviously it will need some borrowings, so it can go ahead and have a good plan to ensure that sufficient fees is received to cover the installments. And later on, if the club does not or the club is not able to have sufficient students in future, it can try to use this facility for some other purpose or provide some other service to the members to ensure that some kind of revenue is generated from this investment. So yes, they should go ahead with the plan. Question number 2. AB PLC is a trading company. The draft profit from operations for the year ended 31st December 2021 was 98,000 before the following items were considered. Okay. On 1st September 2021, AB PLC issued a 6% debenture for 200,000. Interest is payable half yearly. Revaluation reserve at 1st Jan 2021, which is at the opening. So this balance of revaluation reserve is at the opening. Arose from the revaluation of a property on 1st Jan 17, which is 4 years back. Property was purchased on 1st Jan 13, which is 8 years back. It is depreciated using straight line over useful life of 40 years. And on 1st Jan 17, the market value of the property was 432,000. It means on 1st Jan 17, when they created this revaluation reserve, 72,000, they revalued it to this 432,000. So this is the current cost in the books. On 1st Jan 2021, property was again revalued at 296,000. So this is the current market value of the property. No entry has been made to record this. The bookkeeper had continued to provide depreciation for the property based on the value of 432,000. So at the opening, when they knew that the market value of the asset has dropped to 296,000, they should have revalued it on 1st Jan and continued providing depreciation at the new value 296,000, obviously using the straight line method. But they did not do that. They continued providing the depreciation using the old value. So there could be two possible adjustments. One is for the revaluation, and then is the depreciation, incorrect depreciation provided. We'll see how to do this. Third adjustment, in the financial statements 2020, a non-current asset was wrongly classified with the effect that depreciation has been overcharged by 20,000 in 2020, which is the previous year, and 14,000 in current year. So extra depreciation of 20 and 14,000 has been given. AB PLC sells goods at a markup of 60%. In December, defective goods with a sales value of 20,000 were returned. Cost of the returned goods had been included in the inventory. So the cost would be how much? 28,000. We'll have to remove the markup from it. So 28,000 divided by 160 into 100. 17,500 is the cost of the goods. So 17,500 worth of inventory is included. It is expected that 6,000 is incurred to repair the returned goods, and then that can be sold for 80% of the normal selling price. So this is the cost, 17,500. If we talk about the NRV, that will be 80% of the normal selling price, which is 28,000. But we will have to subtract the cost of repairs, 6,000. So 16,400 will be the NRV. So obviously the inventory will have to be valued at NRV and not the cost, but currently it is included in the inventory valuation at cost, so we'll have to make the necessary adjustment. Answer the following questions. Okay, prepare a statement to show the correct profit for the year ended 31st December 2020-21. Okay, let's do that here. Current profit is draft profit 98,000. So we have error number 1, 2, 3 and 4, and at the end we'll get the correct profit. Okay, first error. Debentures were issued, 6% debentures were issued, interest is payable, but no adjustment has been made for the interest. So let's calculate the interest. It's very simple. 6% into 200,000. Since 1st September, so 4 by 12. So that gives us an interest of 4,000. Even though interest is payable half yearly, you don't have to consider that. You have to accrue the interest based on accrual concept. So minus 4,000 because it will reduce the profit. Okay, second one, revaluation reserve. Okay, details are given. We've already discussed the details. I told you here there are two elements. One is the element of depreciation, incorrect depreciation, and then the element of revaluation. Let's calculate first the incorrect depreciation. Let's correct the depreciation. Now, if the value of property is 296,000 on 1st Jan 2021, the correct depreciation should have been how much? 296,000 divided by the remaining useful life. Why? Because what happens in revaluation is once you revalue the asset, you have to continue depreciating the asset using the same method but over the remaining useful life. So in this case, it was bought on 1st Jan 13, 8 years have lapsed, and initially the useful life was 40 years. So now the remaining useful life will be 32 years. So the revised depreciation or the correct depreciation that they should have charged is 9,250. But how much is the incorrect depreciation they are charging? Now they are charging based on 432,000 because it says based on the value of 430,000, and in 2017 when they revalued, the remaining useful life for the after 2017 would be 36 years because before 2017 4 years have lapsed. Out of 44 years gone, so remaining 36,000. So from 2017 onwards, they would have charged 432,000 divided by 36, which is 12,000. Yeah, 12,000. Now correct depreciation is 9250, but they have charged 12,000. So what we can do is we can add the extra depreciation 2750 to the income statement. Fine. Now the revaluation part, let's do the revaluation calculation here on the right hand side. Now what happened on 1st Jan 2021 is that the property was revalued. So whenever you have to calculate the revaluation gain or revaluation loss, you need two things. You need the net book value of the asset on that date and the fair value or the market value. Now market value is given as 296,000. So we will have to compare this to the net book value and see whether there is a revaluation gain or loss. If it's a revaluation gain, we will create or we will put the difference in the revaluation reserve, and that will be shown under equity. If there is a revaluation loss, we will have to charge that loss as an expense in the income statement. So first let's calculate the net book value. Now on 1st Jan 17, the market value was 432,000 and we calculated that 12,000 depreciation would be provided. So they provided 12,000 depreciation in 2017, 18, 19 and 20, 4 years, because property was again revalued in 2021. So 4 years depreciation they've already provided. So before revaluation, 430,000 minus 4 years depreciation into 12,000 each year, 48,000. So the net book value before revaluation is 384,000. And how much are they revaluing it to? They are revaluing it to 296,000. So here we can say that currently the business or the assets is facing a revaluation loss of how much? The difference, which is 88,000. Ideally, this should be put in the income statement as an expense, but the company also has a revaluation reserve credit balance that was being carried forward from 2017 onwards. So this 88,000, first the company can use the 72,000 credit in the reserve to adjust this, to write off this, and then any remaining loss that will be charged as an expense in the income statement. So less revaluation reserve balance 72,000. So only 16,000 will be charged as an expense in the income statement. So what I'll do is I'll show 2750 plus 16,000. Okay, no, 16,000 is an expense. So 2750 minus 16,000. Or you can show them separately also, that's better. So error number 2, depreciation, loss on revaluation. Depreciation is plus 2750, loss on revaluation is minus 16,000. Now one thing that I have to tell you is that if you see the marking scheme, the 16,000 loss on revaluation is missing. They've not considered this. Now there can be two possibilities regarding this. First is that they have missed it, they've omitted it, it's a mistake. Second possibility is that they are assuming that they will put this in the retained earnings column directly in the statement of changes to equity. They will not record it in the income statement. But if you look at paper number 22 of October-November 2021 and question number 1, if you look at this question, there's one adjustment regarding revaluation of the non-current asset. In that, there's the same situation that there is a loss on revaluation. There they have put this loss in the income statement. So you have to consider this loss as an income statement. But if you compare my answer to the marking scheme, it will not match. And I will show you one more text that will give you more clarity. So if you see this is the text from IAS 16, which is on property, plant and equipment. This text tells you that there are two ways to show non-current assets in your books. One is the cost model that we've been understanding ever since IGCSE, since our basics. Cost minus accumulated depreciation, show the asset at net book value. Or there's another way to show the asset always at their fair value. Keep on revaluing the asset whenever you have a good idea about the current market value. And in this case, whenever there is a surplus, you will create a revaluation reserve, and whenever there is a loss on revaluation, you will charge it as an expense in the income statement. Where does it say that? So see, if a revaluation results in an increase in value, it should be credited to revaluation surplus. A decrease arising as a result of revaluation should be recognized as an expense to the extent it exceeds any amount previously credited to revaluation reserve. Basically, whatever credit you have in the revaluation reserve, that you can adjust against the loss, and any loss that exceeds that should be recorded as an expense. So this is what I was trying to tell you. Whenever there's a loss on revaluation, you will have to show the loss in the income statement. So this is in contradiction to what is given in the marking scheme. So I thought I'll just explain this part to you. So coming back to our answer, we've done the error number 2. Error number 3, a non-current asset was wrongly classified with the effect that depreciation was overcharged by 20,000 in 2020. Now the error that you see of 2020, that you cannot record it in the income statement of current year. You'll have to directly make the adjustments to the opening balance of retained earnings section, because that's what is mentioned in the International Accounting Standard, that if any error is committed in the previous years, you will have to make sure that you make the adjustments retrospectively and all the current year's figures are restated considering that error was not made. So this 20,000, you cannot record it as a correction or as a transaction in the current year. You'll have to restate your opening balances to that extent. But the 14,000 is depreciation of current year, and we are preparing the income statement of the current year itself. So for error number 3, we can add back the depreciation because depreciation is overcharged. So plus 14,000. 1 second. Let me make this a little clear. And error number 4 is about inventory valuation. Now here 17,500 inventory is already included, but the correct value is 16,400. So the difference 1,100 will have to be subtracted. So now we will calculate the correct profit for the year, which is 93,650. If you compare this to the marking scheme, as per the marking scheme, the correct profit is 109650. It is because of this 16,000 difference, and I've already explained it to you. Why is the difference here? Okay, let's continue. The equity of AB PLC was the following on 31st December 2020, which is the opening. Ordinary share capital, share premium, revaluation reserve, and retained earnings. Then following transactions are given. On 1st Feb, final dividend is paid. Bonus issue is there. New shares are there. Interim dividend, and again final dividend was proposed. State one difference between rights issue and bonus issue. It's very easy. In rights issue, you receive fresh capital in form of money, which can be used in the business. But in bonus issue, no money is received, no cash is received. It is just a conversion of reserves into share capital. Then prepare a statement of changes to equity. A total column is not required. So let's quickly do that. So we can give the heading on top, statement of changes in equity. I will just use abbreviations here, but in exam please don't use abbreviations. And retain earnings. Opening balance 500,000, 86,000, 72,000, and retain earnings is 192,000. But what did I tell you for adjustment number 3? That you have to restate your retain earnings again as if the error was not there only, or you've corrected the error. You'll have to restate your retain earnings. So this retain earnings becomes 212,000, which is 192,000 plus 20,000 from error number 3. Then let's look at the transactions. Final dividend of $0.08 per share was paid from the 2020 profit. So final dividend paid. Number of shares 500,000. So 500,000 into 0.08, 40,000. So in the retain earnings column, minus 40,000. Then bonus issue, 1 for every 10, and reserves were kept in the most flexible form. So since we have balance in the share premium, we are going to use that first. 1 for every 10, so it means 50,000 additional bonus shares were issued. So minus 50,000 in share premium. On 1st June, 100,000 new ordinary shares were issued at 1.8, but subscriptions are received only for 80,000, and company gave in those many shares and received the money for that. So ordinary shares issued 80,000 shares, and since it is issued at $1.8, out of that $1 is face value, so the remaining 0.8 is share premium. So share premium is going to increase by 64,000. On 1st September, interim dividend of $0.02 per share was paid on all shares held at 31st March. This is very important because on 31st March, the new shares were not issued. So you're not going to pay interim dividend to the shareholders of these new shares. So interim dividend only on 550,000 shares, which is the original 500,000 shares plus bonus shares 50,000. So 550,000 into 0.02, 11,000 will be paid from the retained earnings. Now, if you see, opening balance of revaluation reserve 70,000, but what did we do? We used it to write off the loss. So revaluation loss 72,000, and then profit for the year will also be recorded here. As per our answer to part A, correct profit 93,650. So let's calculate the closing balance. So 630,000, share premium 100,000, revaluation reserve becomes 0, and retained earnings becomes 254,650. If you compare this to the marking scheme, your retained earnings will be correct. Closing balance. Why? Because what they've done is they have recorded the 16,000 loss that we put in the income statement. They have recorded as a direct adjustment to your retained earnings. But we have recorded it as a loss in the income statement. So that is the correct treatment, as I told you. So yeah, that completes part D. Question number 3. The directors of KPLC provided the following information: profit, dividend paid, ordinary share capital, retained earnings, general reserve, revaluation reserve, and 8% debentures. Market price is $2.4. Explain two ways in which accounting ratios may be used by potential investors to assess the performance of the business. There are many ways in which investors can use the financial statements. They can look at the income statement and the profitability ratios to assess the profit potential of the business and compare it with the competitors. Obviously, they will want to invest their money in the business where the profit potential is highest. Then another reason why would shareholders or investors would want to use is to assess the liquidity situation of the business, liquidity condition of the business. Does the business have enough liquidity? Does it face the risk of shortage of cash to pay its liabilities in future, so that their investment is not in a risky company, in a risky business? And there are many other things that you can write. You can say that they would want to decide whether to purchase the shares of that company or no. You can say that they would want to do inter-firm comparison or intra-firm comparison of the numbers with the previous periods. Any answer is okay, just explain it properly. Calculate to 2 decimal places the following ratios. So number B, first one, PE ratio is equal to the market price of the share upon EPS. EPS will be the profit for the year, 114,000, divided by the number of shares, 600,000, so $0.19 per share. So that gives us a PE ratio of $2.40 upon $0.19, 12.63. Then we have dividend yield. Dividend calculated as a percentage of the market price of the share. So dividend yield is equal to dividend per share divided by market price per share. So how much is dividend per share? See, dividend paid is 90,000. Okay, let's calculate here. Dividend per share is equal to $90,000 divided by 600,000. So $0.15. So dividend yield becomes $0.15 upon $2.40, which is 6.25%. Then income gearing ratio, which is the calculation of interest as a percentage of the overall profit from operations. So interest upon profit from operations into 100. How much would be interest expense? 8% of 150,000 debentures, so 12,000. And profit from operations would be the profit for the year, 114,000. To this we will add back the debentures because add back the interest on debentures, because interest on debentures is already subtracted. So 114,000 plus 12,000, 126,000 into 100. So 9.52%. Then we have the gearing ratio, which is the ratio of fixed cost capital. In this it will be debentures, 8% debentures divided by the equity. Okay, if you want to write the formula, what we'll do is we'll write it as non-current liabilities upon equity plus non-current liabilities. Non-current liabilities in this case is 150,000, 8% debentures, and equity will be your ordinary share capital, retained earnings. But retained earnings, if you see, is given on 1st Jan. It's not the closing retained earnings. To calculate the closing retained earnings, what will you do? You will take 38,000. You will add the profit for the year 114,000, and you will subtract the dividend paid 90,000. So you get 62,000 as the closing retained earnings. To this we will add the general reserve and the revaluation reserve. So the total equity would be 817,000 and non-current liabilities 150,000. So when we calculate the ratio, we get 15.51%. And then we have the return on capital employed, ROCE, which is profit from operations upon capital employed, which is same as equity plus non-current liabilities into 100. So profit from operations also we already calculated in third one, income gearing. So 126,000 divided by 962,000 capital employed multiplied by 100. So 13.03%. Additional information: the directors are considering declaring a proposed dividend of $0.2 per ordinary share due to the low level of retained earnings. They ask the accountant whether the dividend can be paid out of the reserves or no. First, let's calculate how much dividend are they planning to pay in dollar terms. How many shares do they have due? 600,000. So 600,000 into dollars 0.2, $120,000 of dividend they want to pay. For this, they need to have reserves or retained earnings balance. So let's see if they have general reserve 75,000 plus retained earnings closing balance was 62,000. Overall, they have 137,000 worth of reserves. So yes, they can declare this much of dividend. So what you'll have to write is you'll have to say that dividends can only be declared and paid out of revenue reserves or profits that are realized in cash. In this case, revaluation reserve cannot be used to pay dividend because it's a capital reserve, and secondly the profits are also not realized in cash. It's just a book adjustment. And then you can compare and say that even though only retained earnings and general reserve can be used to declare dividend, they still have sufficient balance in the reserves to declare a dividend of 120,000, so they can go ahead and declare the dividend. Then additional information: directors are thinking of investing 100,000 in a new project. The project will generate a profit of 24,000. Before interest, they have two options: to issue new ordinary shares or issue a further 8% debenture. Advise, what would they choose? So you can give advantages and disadvantages of having shares. For issue of ordinary shares, the disadvantage is that there will be a dilution of ownership, but the advantage is that it's a permanent source of capital. And then for issue of ordinary shares, you can say that since the business can earn a profit of 24,000, and from this 24,000 they will pay 8% of interest to the debenture holders. So 16,000 is still left for shareholders, so they can go ahead with the issue of debentures. And another way of saying it is that 24,000 when calculated as a percentage of 100,000, they are making 24% return from the investment by borrowing at only a rate of 8%. So overall, the shareholders are getting an advantage of receiving money at a lower rate and investing and making higher returns. So that you can say. And you can also say that if you see the current gearing ratio of the company, it is not very high. The company is not highly geared. Even the income gearing ratio is decent. They can manage to pay more interest from the profits. So issue of debentures is also a good option. So I would advise to go for issue of debentures so that the ownership is not diluted and to ensure maximum possible returns to the shareholders. Now let's do question number 4. Alan and Bobby were in partnership sharing profits and losses in the ratio 3:2. The partnership statement of financial position on 31st March 2022 was as follows. Okay, non-current assets are there, current assets are there, capital and current accounts are there, then current liability is there. A company Limited acquired Allen and Bobby's partnership business on 1st April 2022. Company acquired all the assets except bank and motor vehicle. So motor vehicle and bank, these two were not acquired. Motor vehicle was taken over by Allen at the value of 18,000. Okay, and partnership paid 45,000 in full settlement of trade payables. Since partnership is paying trade payables, it is obvious that trade payables were also not taken over by Limited. First they said all assets except bank and motor vehicle, and then for trade payables obviously it is not taken. So these three elements are not taken over by the new business, new company. The partnership paid 45,000 in full settlement of trade payables. Okay, the value of assets taken over by Limited. So these are the current values of the assets, and the goodwill of the partnership was also agreed at 40,000. So they have decided to pay 40,000 as goodwill. Purchase consideration was settled by ordinary shares issued at a price of $1.4. The total purchase consideration that they've not given the amount directly, we'll calculate it, and the shares were split between Allen and Bobby equally. Okay. Answer the following questions in the question paper. Okay, questions are printed here for reference. Part A, prepare the statement showing partners' share of profit or loss on realization. You could either prepare the realization account or you could do it in a form of a statement. Let's do it as a realization account since we understand that already. But even if you do it as a statement, it won't be wrong. So realization account. On the debit side, we will be recording first book value of all the assets except bank. Credit side, we'll be recording all the liabilities except partner's loan. Partner's loan is anyways not there, just trade payables is there. So let's start with that. Trade payables on the credit side and all assets except bank on the debit side. So land and building, equipment, motor vehicles, inventory, and trade receivables, 93,000. Then they tell you that Allen had taken over motor vehicle, that will come here on the credit side, 18,000, and they tell you that the firm had paid trade payables at 45,000, so that will be recorded here on the debit side, 45,000. Apart from this, for all other assets, we will be getting purchase consideration, or the firm will be getting purchase consideration from the company in form of shares here. So we will just be recording the purchase consideration. How much is the purchase consideration? See, normally in questions, you are supposed to calculate the goodwill, and we calculate it as the purchase consideration, which is the price paid for the assets acquired, minus the value of the assets acquired. Whatever extra price you pay, that's a goodwill. But in this case, goodwill is given as 40,000. Purchase consideration we don't know. And net assets taken over is 730,000. So the purchase consideration becomes 770,000. So this will be recorded on the credit side of realization account, 770,000. So now let's calculate the profit or loss. So when we take the total and calculate the profit or loss on realization, we get it as 56,000. This will be shared by the partners, Allen and Bobby, in the ratio 3:2. So 33,600 and 22,400. So that completes part A. Part B, prepare partners capital account in a columnar format. So capital account, both sides we'll have column for Allen and Bobby. Starting with the balances brought down. From the balance sheet, balance brought down is 400,000 for Allen, 320,000 for Bobby. And the current accounts will also be transferred to the capital account in case of dissolution of the firm. So credit side B's current account, which is Bobby's current account, 25,000. But for A, we will do it on the debit side. Why? Because Allen's current account is having a negative balance. Negative balance means a debit balance in the current account. So debit side is current account, 6,000. Then for the realization profit or loss, in this case it's profit, so realization profit on the credit side, 33,600 and 22,400. And then Allen had taken over motor vehicle, So that will be charged to his account on the debit side. In bracket, if you want, you can write motor vehicle 18,000. Then the shares of the company Limited against the purchase consideration 770,000 worth of shares will be received, right? So that will be shared by the partners equally. Here at the end they say equally. So shares of Limited. If they don't mention equally, let's say nothing is mentioned about distribution of shares, you can divide it in the profit sharing ratio 3:2. But here they tell you equally. So 770,000 when divided equally, 385,000 each. And finally, whatever is the difference in the partner's debit or credit side, that will be either paid through the bank account or received from the partner through the bank account. So for A, the total on the credit side when you take is greater than the total on the debit side. So you will get a balance on the debit side of 24,600. And for B, which is Bobby, you will get debit side total greater than the credit side. So you will have to receive money from Bobby, which will be equal to 17,600. If you want to check whether your answer is correct or no, a quick check, what you can do is you can quickly try to reconcile the bank account. Opening balance in the bank account is 52,000. Now, from this, the firm will pay 45,000 to the trade payables, pay 24,600 to Alan, and receive 17,600 from Bobby. So when you try to do this, you will get the bank balance eventually turns out to be 0. Once it turns 0, it means yes, at least mathematically there is no mistake. Okay, that completes part B. Part C. Prepare the journal entries in the books of Limited to record the acquisition. So there'll be two journal entries, one to buy the assets and then second one to pay in form of ordinary shares. So when you buy the assets, you will have to debit all the assets that you have taken over. So land and building debit. Be careful, all at the market values or the agreed values, not at the original book values in the books of A and B. So land and building 410,000, equipment debit 132,000, motor vehicle debit 30,000, inventory debit 70,000, trade receivables debit 88,000. And apart from this, the company has also taken over goodwill. They've paid 40,000 for goodwill, so 40,000 debit goodwill. And everything will be credited to A and B, Alan and Bobby's firm. So Alan and Bobby. Credit, which should be equal to the purchase consideration, which is 770,000. And then you will, in the second entry, you will debit Alan and Bobby, and credit the shares that have been issued, so ordinary share capital. But since the shares are issued at premium, so there will also be a credit in the share premium. Now 770,000 is the total value of the shares. The issue price is $1.4, so number of shares will be 550,000 shares. So 550,000 into $1 will go in ordinary share capital, and into $0.4 will go in share premium. So credit will be 550,000 and share premium credit will be 220,000. So that also completes part C. Part D, define the term intangible asset. So asset means anything that has a monetary value for the business. So intangible asset is anything that has a monetary value for the business, but that does not have a physical substance, that cannot be physically, that cannot be touched or seen physically. Discuss the reasons why the purchase consideration was more than 730,000. Question is, when you are buying assets worth 730,000, why are you paying more than that? The company has paid 770,000. So you'll have to say that the company has paid 40,000 extra. This is for the goodwill. Goodwill is the amount that the company has paid for the reputation of business of Allen and Bobby, because their business, their reputation will help the company earn profits in the future. And this reputation may come from different factors like a favorable location, a good customer base, management, employees, or any kind of factor that improves the efficiency of the business. So all of these points you will have to explain. F, advise the directors whether or not they should have paid more than 730,000 for the partnership. Justify answer. So since 3 marks, so what you can do is 1 point you can write that yes, they should pay extra because their business, Allen and Bobby's business, will help the company earn extra profits in future. So it's okay to pay a little more money and get the entire business. But how will you decide how much goodwill is okay to pay? Maybe you're paying more goodwill. So it is very difficult to actually calculate the correct value of goodwill, so that you can say and for no, and then eventually you can justify. If I were at your place, I would justify by saying that it is okay to pay 40,000 as goodwill, as this amount is much lower as a percentage. It is not very high compared to the overall value of net assets taken over, and probably the company will be able to justify this payment by earning decent profits from business of Allen and Bobby in future. If this goodwill amount was really high, let's say against the net assets 730,000, if the goodwill was, let's say, 200,000, 300,000, then I might say that it really depends on the nature of their business, and probably this much payment may not be really necessary. But since the goodwill amount is less here, I will justify by saying it's okay to pay that money. Question number 5. The directors of E Limited are concerned about company's future cash position. They have asked the management accountant to prepare a cash budget for 3 months ended 31st August 2022. Actual sales and budgeted sales are given for each month. Sales are on credit and they are paid 2 months after purchase. Goods are sold at a markup of 50%. So goods are purchased 1 month before sales. 60% of the purchase are paid in the month of purchase to get a 2% cash discount, and the remainder is paid in the following month. We Limited keeps no inventory at the end of each month apart from the goods purchased for the following month sales. Okay, wages were 50,000 and overheads 20,000 paid in the month in which they incurred, but from 1st July wages will increase by 10%, so it becomes 55,000 in July and August. Rent is 60,000 per annum, payable half yearly in advance in July and Jan. Since half yearly and annual rent is 60,000, so in July they'll pay 30,000 rent. The balance at the opening is 33,000 in June, on 1st June. Explain one purpose of preparing a cash budget: to identify any surplus cash that may be arising in the coming period, and to ensure that this surplus cash is used or invested to ensure maximization of returns for the business, or to assess whether there is going to be any cash deficit in the coming period, and to make sure that sufficient arrangement is made to finance this cash deficit. So anything is okay. Prepare the cash budget for each of the 3 months ended 31st August. So we'll have 3 columns on the right hand side: June, July and August. Receipts first. When it comes to receipts, there's only one receipt, which is collection from customers. So collection from debtors, and then we'll have the payments. When it comes to payment, there will be payment to creditors, but under that, in the month of purchase, and month following purchase. Then wages paid, overheads paid and rent paid. That's it. So then we'll have the total of the payments, and then at the end you can show the net receipts and payments, the opening balance and the closing balance that you can do. I'll show you the receipts and payments, the calculation of receipts and payments. Okay, so collection from debtors in the month of June. So all sales are on credit and customers pay 2 months after purchase. So in June, customers are going to pay for the goods sold in April. So this is going to be easy. April sales collected in June 234,000. May sales collected in July 210,000. And June sales collected in August 195,000. Then payment to creditors. So goods are purchased 1 month before the sales. And for example, let's say June sales. For these June sales, the goods will be purchased in May. May purchases. Now for these May purchases, 60% will be paid in May itself, but 40% will be paid in June. Now the 60% that is paid in May, that will be paid at 98% because 2% will be cash discount. So in the month of June, payment to creditors in the month of purchase, they are going to purchase for July. So let me show you this value, number 1 here. They are going to purchase for the month of July. Goods sale value of these goods will be 207,000. First of all, we'll have to remove the markup from them. So divided by 150 into 100. Now these will be the value of purchases in the month of June. Now out of this, 60% will be paid in the month of June itself and only 98% will be paid. So $81,144. Like this, you can calculate for July also. So for July, it is going to be August sales 228,000. Remove the profit element to get the cost. 60%, 98%. So 89,376. And the same thing if you do for September sales, you will get the payment in the month of purchase for August, which is 84,672. Now payment in the month following purchase. Basically in June, you will pay for the purchases made in June 60% and you will pay for the purchases made in May 40%. Now what will you purchase in May? You will pay June purchase. You will purchase for June in the month of May and pay that in June. So let me show you the calculation here, number 3. So June sales is 195,000. This will be purchased in the month of May. So we will remove this and 40% of this will be paid in June. So $52,000. And for July, month following purchase, we will take July sales, which is 207,000. Remove the profit and multiply it by 40%. So 55,200. Same thing when you do for August sales, you will get 60,800. You could also do a proper working note showing what purchases are made in each month and when is that paid, and then write the amounts directly here instead of doing calculations like this. Any presentation is okay. Wages paid 50,000 in June, but from July and August it turns out to be 55,000. Overheads is 20,000 each month. And rent paid 30,000. So then when you take the total of the payments for June, it is 203,144, for July 249,576, and for August 220,472. And then net receipts you can get by subtracting the receipts and payment. Then opening balance given in the question, adjustment number 7, if you see, is 33,000. So once you have the net receipt and payment for June, you will add that to the opening balance. You will get your closing balance. Then you will take this closing balance as opening balance for July. You will get your net receipts here. Sorry, this is not the opening balance. This closing balance of June will be the opening balance for July, and you will also get your net receipt payment here. You will add them, you will get the closing balance for July. That becomes the opening balance for August, and then you get the closing balance for August as well. Prepare budgeted income statement for the 3 months ended 31st August 2022. So I'll just briefly do here. Sales. What will be the sales for June, July, August? Basically the total of these sales, 3 months sales, which is 630,000. How much will be cost of sales? It's very easy. Out of this 630,000, 50% is markup. So what I can do is, to get the cost of sales, I will do 630,000 divided by 150 into 100. I will get the cost of sales, which is 420,000. And then we get the gross profit, 210,000. And then expenses. What all expenses do we have? We have our wages, we have overheads, we have rent. You don't need to calculate the purchases and then add it and all. You don't have to do that. You can directly show the cost of sales. If you do the purchases calculation and all, it'll become a little more lengthy, but directly cost of sales is okay. Okay, we also forgot to take the discount received as other income. Now, how will you calculate the discount received? One very simple way I'll show you. What you can do is, you can take the total of the payments made, these 3 payments, 81,144 plus 89,376 plus 84,672. Now the total payment made is 255,192. Now remember, this is 98% of the total amount that was due. We need to find the 2% cash discount. So divided by 98 multiplied by 2, you could directly get your cash discount amount, which is 5208. You don't have to go back to the purchases value, find out 60%, then 2%. You can directly do it in this manner. So discount received will be added 5208. Wages will be minus 160,000, because 50,000 for June and 55 for July and August. And then we have overheads, 60,000, and rent. Now 60,000 is an annual rent, so for 3 months rent will be 1/4, 15,000. Then you will calculate your profit, budgeted profit. Just make sure you do it in a proper income statement format. Additional information: the director suggests that a new credit policy to improve the cash position of the company for the 3 months ended 31st August 2022, a 3% cash discount is to be allowed to customers who pay 1 month after sales. It is estimated 50% of the customers will take the discount, and this new credit policy will apply to the sales made in May and thereafter. Fine. Calculate the effect of the new credit policy on the company's cash receipts for each of the 3 months that ended on 31st August. So for the 3 months, we'll have to see what will be the new receipts when the policy is implemented. We'll compare it to the old receipts and we'll see how much is the difference for each month. So we could do a format like this, 1 column for each of the months. So first we'll say receipts as per new policy. Collection from customers. Month after sale. And then 2 months after sale. So for the month of June, firstly, April customers will pay in full because this policy is implemented from May. So April customers are still going to pay in June. So in June, the business is going to receive 100% of April sales. So, okay, we'll also create one more. Okay, do 2 months. We can put the April sales here in 2 months after sale, which works out to be April sales was 234,000. So 234,000. And in the month following the sale, which is sales for the month of May, 210,000, 50% of the customers will be availing the discount. So 97% of the 57% will be collected. So number 1, 210,000 into 50% into 97%. Yep. Okay. So that works out to 101,850. And then in the month of July, they will collect June customers 50% into 97%. June sales is 195,000 into 50% into 97%. So 94,575. And in the month of July, they're also going to collect 50% of May sales. May sales is 210,000, 50% will be collected, which is 105,000. Then in August, they're going to collect 50% of July sales into 97%. So July sales 207,000, 50% into 97%. So 100,395. And in the month of August, they will also collect 50% of June sales. 195,000 into 50%, 97,500. So this is going to be their new receipts or receipts under the new policy. Let's take a total. 335,850, 199,575 and 197,895. This will be compared to the receipts as per old policy, which is here on the left hand side. We have 234,000, so 210,000 and 195,000. So either there can be an increase or there can be a decrease compared to the old policy. So the increase in the first month, which is June, will be 101,850. Second month there will be a decrease in 10,425. And third month there will be an increase of 2,895. So they've just told you to calculate the effect, and we've calculated the effect in part D. Part E, comment on the effect of the new credit policy on company's profitability for the 3-month period. So it'll also this policy might also affect the income statement. How it will affect the income statement? It'll affect the income statement because of the discount allowed to customers. Other than that, there will be no change. When you collect the money from your customers, it will not affect the income statement, but yes, the discount allowed will affect the income statement. So how can we calculate the discount allowed? Like we did for discount received, we are going to take a total of all the amounts collected under the discount policy that is the 97%. We will divide it by 97 and multiply it by 3. So discount allowed during June to August will be equal to 101,850 plus 94,575 plus 100,395, the whole thing divided by 97 multiplied by 3. So 9180. So the effect is that the profit will reduce by $9180. Simple. So that's it in the question. Question number 6. The directors of M Limited plan to buy a machine for a new product at a cost of $160,000. It has a useful life of 4 years. Number of units produced and sold are expected to be as follows for each of the years they've given, and total they've given 25 to 100. Unit selling price is $28. Variable cost is $10 per unit. Annual fixed cost including depreciation is $90,000. So let's calculate the depreciation. Depreciation will be 160,000 cost divided by 4. 40,000 is the annual depreciation. So fixed cost excluding depreciation will be 90,000 minus 40,000, 50,000. The fixed cost will increase by $10,000 each time the production is increased by up to 1,500 units. So up to 6,500, it is 50,000 excluding depreciation. The moment you increase it by 1,500, which is you make it 8,000, it'll increase by 10,000. Then next 1,500, it'll go to another 10, it'll increase by another 10,000 and so on. Part A, calculate the net cash flows for each year throughout the life of the machine. Okay, we can do that using a table. We'll have one column for output, then we'll have one column for revenues, or we can directly write, let's say, contribution, because selling price per unit and variable price cost per unit is given. We can directly multiply it with the contribution per unit. Then we can have one column for fixed cost, and finally we'll have the last column for cash flows. So here, output, contribution, fixed cost, and cash flow. First year, second year, third year, fourth year. Output is 5,000, 7,500, 8,500 and 4,200. So contribution per unit is $18. We can also put up a working note below this table. Contribution per unit is equal to selling price minus variable cost is equal to $18 per unit. That's number one. And second working note will be for the fixed cost excluding depreciation that we've already done. So number 2 for that. Okay, contribution 5,000 into $18. We will have 90,000. 7,500 into $18. So we will have $135. $135,000. Then 8,500 into 18. So 135. $153,000. 4,200 into 18. $75,600. Okay, fixed cost for the first year is going to be 50,000 excluding depreciation. So here you can write in brackets excluding depreciation. So up to 6,500 it is 50,000. Then as per the question, it will increase in a stepped manner. So for 7,500 it will be 60,000. For 8,500 it will increase by another 10,000, so it becomes 70,000, and at 4,200 it again reduces to 50,000. Cash flow will be 90,000 minus 50,000, 40,000. Then we have 75,000. Then we have 83,000. And then we have 25,600. They are not telling you to calculate the total, just throughout the life of the asset. So for 4 years we've done it. Then additional information is given. Cost of capital is 10%. For 10% discounting factor is given. 16% also they've given discounting factor. Calculate for the proposed purchase the NPV. NPV, you will always use the discounting factor for the rate which is equal to the cost of the capital. So since the cost of the capital is 10%, for NPV we are going to use 10% discounting factor. Always remember that. Then also they tell you to calculate IRR. So for that they've given us another set of discounting factors so that we can calculate the IRR. But first we are going to do it for 10%. So what I'll do is I'll just continue here, but in exam obviously you'll have to do it as a separate statement. So I'll just, okay, no, we'll have to do it as a separate statement because then year 0 is not mentioned here in my table. So we'll do it as a separate statement. Part B. One column for cash flow, then discounting factor, then present value. So year, cash flow, discounting factor at 10%, and present value of the cash flows. So 0, 1, 2, 3, 4. Cash flow for year 0, we'll pick it up from A. We have to spend on the machinery 160,000. Then in year 1 it is 40,000. Year 2 it is 75,000, 83,000, and 25,600. Discounting factors, we will pick it up from the question. For year 0 it is always going to be 1. For year 1 they have given it as 9.909 for 10%. For year 2 it is 0.826. For year 3 it is 0.751, 0.683. You'll have to multiply. So let's say for year 0 it is negative 160,000. Then you'll have to multiply for each of the years, and at the end you'll have to calculate your net present value, which works out to be 18,128. Then they also tell you to calculate the IRR. For IRR, first of all, what we need is one set of discounting factor that generates a positive NPV. So we have 10% rate at which the NPV is 18,128. Then we need another set of discounting factor for which the NPV is a negative number. So they've given us 16% discounting factors. We will use that. We'll calculate the NPV and see how much it comes to. So what I'll do is for part B, the second part, I'll continue here itself. But in exam, do it as a separate statement. So discounting factor at 16% and present value. Again 1.00. So discounting factor 16% is given 0.862, 0.743, 0.641, 0.552, and then you will same way multiply for each of these, and then at the end get the total NPV, which works out to negative 2461. So for 16% discounting factor, we have a negative NPV of 2461. Now we can calculate the IRR for which the formula is the rate that is giving the positive NPV, which is 10%, plus the difference between the rates between the positive and negative NPV. So 16% minus 10%. This multiplied by positive NPV in the numerator 18,128, and in the denominator positive NPV plus the negative NPV 2461. So when you simplify this, you will get an IRR of 15.28%. So we're supposed to calculate that only in part B. We've done it. Advise the directors whether or not the machine should be purchased. Justify your answer. See, if you use the NPV method, yes, cost of capital is 10%, and if you use that rate to calculate the NPV, it is coming as a positive number. Whenever NPV is greater than 0, it's a positive number. You can say that the project should be accepted. It is beneficial for the business. And when we try to use the IRR method, because since it's 3 marks here, if it was just 1 mark or probably even 2 marks, I would have given the justification based on NPV, but since 3 marks, so based on IRR also you can say that since the IRR, which is 15.28%, is greater than the cost of capital 10%, it means the business is expected to make more returns than its cost of capital, so the project should be accepted. So part C, yes, the project should be accepted. Additional information, the directors decide that the NPV method should be adopted. One of the directors has concerns about the total sales target. So to achieve the total sales of 25,200, he has the following suggestions. The selling price should be reduced by $1. Advertisement cost 8,000 should be incurred in year 1 and 3. And the units produced and sold for each year should be the same. Basically 25,200 units. They want to divide it equally over 4 years. So 6,300 for every year. Explain what is meant by the term sensitivity analysis. So sensitivity analysis includes or involves understanding the effect of the change in the assumptions that we make while taking a certain decision using any kind of investment appraisal technique. We have some assumptions. So what if we change those assumptions, and what will be the effect of those changes on our decision and on the calculations that we've done? That is called the sensitivity analysis, wherein you try to change the assumptions and understand the effect of those changes on the decision. So that's part D. Part E, assess the impact of director's suggestion on the decision to buy the new machine. Our initial decision of the directors was to buy the machine. Yes, they decide to buy the machine. Now the question is, after all these changes, is that decision changing? So we'll have to calculate, we'll have to analyze the effect of these changes and see. We will again use the NPV method and see if the NPV is coming, either it is coming greater than 18,128, which is the earlier NPV, it is coming less than that, or is it coming as a negative number? If it is coming as a negative number, definitely we will reject this proposal and the new machine will not be bought. If it is coming as a positive number, the machine will still be bought because NPV is positive. It will not affect the director's decision, but it is obviously less profitable compared to the earlier proposal. And if it is higher than 18,128, yes, it is even a profitable proposal compared to the old proposal, and it will have no impact on the director's decision to buy the machine. So how will we analyze the effect? So what you can do is the same table that you have done in part A, you can again recreate it by having equal units, 6,300 units every year. Contribution per unit this time will be $17 per unit because selling price is reducing. When it comes to fixed cost, you will have to increase your year 1 and year 3 fixed cost by another 8,000, and then you can get your cash flows. Then you can get your discounting factor for 10%, and then you can calculate the present value. That is the best way to do it. It's a little lengthier way of doing it, but at least you will understand what you're doing. You will not make any mistakes. There's another way of doing it. See, when the annual cash flows are equal, in this the output is going to be 6,300 every year. The contribution per unit is going to be same every year. The fixed cost is going to be same if we don't consider 8,000 for now. Let's say that 8,000 you're not considering. So every year the cash flow is going to be same. So when you have that, what you can do is to calculate the present value of all cash flows, you will add up the discounting factors of all the years. 0.909 plus 0.826 plus 0.751 plus 0.683. Multiply this with the annual cash inflow that you get in year 1, 2, 3, 4, whatever it comes to. From this, you will have to adjust the initial cash outflow of the machine 160,000, and for the 8,000 that is incurred in year 1 and 3, you will have to do that 8,000 into year 1 0.909 plus year 3 discounting factor 751. You will get the same answer. But I think this will be a little confusing unless you really study time value concepts properly, or you have studied net present value concepts really properly, then you will understand this. Otherwise, this table is still okay. You can do that also. So then once you do that, you will realize that the NPV is coming to positive 7670, and hence your decision will be, or your answer will be, that it will not impact the director's suggestion to buy the machine. The directors can still go ahead and buy the machine as the NPV is positive, but yes, the proposal is less profitable compared to the earlier proposal. So that completes question number 6. Now coming to paper number 33. If you look at paper number 33, it is exactly same as the paper number 31. So I've already done that, so I'm not going to do this. Obviously, I'm not going to do this again. So that completes our May-June 2022 paper 31 to 33. That completes this series. So hope this video is really useful for you. Hope you're learning new things, and let me know if you have any doubts in the comment section. Let me know if you have any other suggestions. I will like to hear it from you. Thank you for being there.